Hello and welcome everybody. I don't know if people can hear me as I'm just letting people in. Just having the Landlord webinar masterclass. I think sometimes we get a few people sort of join a little bit later or part way into the session. So hi Geoff, I can see you there. Oh yeah, somebody else in the waiting room. So I'll continue to add people as we sort of go along. But just wanted to welcome everybody to this. This is, I think, our second or third Landlord webinar masterclass, and I'm joined again. Thank you for Geoff Noble from Certax Accounting. He's joining us, so he's a property tax specialist. He actually looks after a lot of our landlords, helping them set up their limited companies, or even just our landlords and their tax returns. Letting somebody else into the meeting. Little bit of background. So myself, I've been an active landlord for about 20 years. I run an estate and lettings agency, and I have a financial advisory business. So I'll be talking about landlord strategies and sort of market trends after Geoff's told us a little bit more about, gone into the ins and outs and pros and cons of setting up limited companies as special purchase vehicles, and the pros and cons of sort of purchasing or moving your portfolio into that for tax purposes, as opposed to more traditional methods of purchasing. So if we start, Geoff, are you okay if we start with you? If you sort of explain sort of the ins and outs of the sort of limited company structures, and then what I'll do is talk about the strategies and a little bit more about yields and rates, and then we can also throw the webinar open to an open question forum. So you can post a question on here, or you can post a question on Facebook if you're watching via that way. We've got somebody sort of in the background sort of looking at the questions. You can raise them to us and we can answer those at the end. So over to Geoff.
Thank you, Paul. Evening, everybody. I'm not sure what the composition of people attending the meeting, the webinar is, whether you're first-time investors or current property investors, but the rules for taxation of property income has changed quite radically in the last 4 to 5 years. So previously, going back a few years, it was quite rare for people to want to have buy-to-let properties in a limited company environment. And that would be irrespective of whether you were personally a higher rate taxpayer or a basic rate taxpayer. And then in their infinite wisdom, the government decided they would change the basis of allowing tax relief on interest on loans taken out for the purchase of residential property. And over a period of 4 years, we had some transitional rules, but they're now fully in place. So what used to happen in the past was you'd have your rents received, you take up for all your other allowable expenses against the rental income, and what you had left, you would then deduct the interest on the buy-to-let mortgage as an expense, and you would pay tax on whatever was left over, and that would be your marginal rate of tax, whether it be basic rate or higher rate. What happens now is that the interest is not deducted as an expense, so you are charged to tax on your profits from the rental business, excluding loan interest and any other finance charges, and you pay tax at 20% or 40%, or for some people 45%, depending on your other circumstances. And then you deduct from that tax due figure calculated a credit which is equivalent to 20% of the loan interest paid. So what it means for higher rate taxpayers is that they're now paying a lot more tax on personally owned residential property than they used to. And this has driven a lot of people to consider, can they put existing properties into limited companies, or can they look at, there's a general sort of consensus amongst certain people that putting new properties into limited companies is the way to go. I can't give you that simple an answer because the straightforward answer is it depends on everybody's individual circumstances. So basically, in terms of putting, or the advantages of putting a property into a limited company, if you're not wanting to have the income from the property investment to supplement other personal income, and you're prepared to leave it in a company environment, perhaps to accumulate in order to finance the deposit on the next buy to let and build up a portfolio that way, then a limited company may well be the way for you to go at the moment if you are a higher rate taxpayer, or if you're at an age where you're not a higher rate taxpayer, but you expect your earnings to increase as the years go by, and you will become a higher rate taxpayer in later years. So in those circumstances, I think most definitely well and truly worth looking at a limited company route. If you're wanting to extract all of the income from the profits of the rental activity as personal income, then one of the downsides of the way it works with the company is the company pays 19% corporation tax on the profits from the venture, and that's having deducted the loan interest on the buy-to-let mortgages. So 19% is cheaper than the personal tax rate, but if you then want to take the net of tax profits out of the company environment for your own use, you end up paying tax on the dividends that you take from the company, and that can give rise to additional personal tax, which can increase the overall tax burden and then make it less preferable than the tax that would be payable under the personal route. So the simple answer, and there is no simple answer, is company or personal ownership better? It depends on everybody's individual circumstances. Most definitely the new rules for taxing rental income have made a significant difference. Without sort of overcomplicating things and knowing the background of everybody's tax knowledge and rental activities, there are further complications. Let's say you have income of £45,000 before rents, and you've got a couple of kids on which you're claiming child benefit. Now, for child benefit, when your taxable income goes over £50,000, you start to lose a percentage of the child benefit, and when you get to £60,000, the whole lot of it has had to be paid back. Now, for somebody who's got £45,000 income, but they receive £15,000 worth of rental income before loan interest, they may be paying £10,000 loan interest on that rental income, so that their profit is only £5,000, and they're just under the 50,000 in total. But from a taxable income point of view, their income is actually £60,000 because you include the 15,000 before deducting the loan interest. So they would then have a massively higher marginal rate of tax because they're having to pay child benefit back. And similarly, for anybody who's hovering below the £100,000 total income, once your total income goes over 100,000, they take away £1 of your personal allowance for every £2 of income you have over 100,000. So again, the new tax rules mean that some people might have an extra 10, 15, 20,000 pounds of taxable income, even though their actual profits from that rental venture are very small. So the answer to should I buy in a company or should I buy personally, the answer really is to have a chat with somebody and look at your individual circumstances and get the advice from there. There are other options available, and limited liability partnerships are now touted as a fantastic way of owning property. Again, they can be. The way they work is that you are taxed the same as you would be, you're taxed on your share of the profits from the limited liability partnership as personal income. But what people do is set up a limited liability partnership and have a limited company in the background, which is a member of that LLP. So it's a way of keeping some advantages, but actually transferring a lot of the income to a limited company environment and keeping your options open. A bit of a halfway house, works for some people, doesn't work for others. I should mention as well that corporation tax rates will increase from April 2023, and they'll be going up to 25%. But on the first £50,000 of profits, they still remain at 19%. So, as you know, for anybody who's got one or two properties in the limited company environment, you're not really going to be impacted by this particularly. But if it's a multi-property environment and the profits could be over £50,000, then you need to just be prepared and perhaps have a bit of advanced planning to look at the tax position on the company, because you may end up paying a lot more tax than you are at the moment on the profits from the venture. And just one other point on that, there's a lot of people out there, including quite a few accountants actually, who've interpreted the increase in corporation tax to say that the £50,000 starting band of 19% doesn't apply to what's called a close investment holding company. Now, a close company is a company that has in general terms, fewer than 5 directors or shareholders, and a close company that has investments, and residential property would undoubtedly be an investment, would be classed as a close investment holding company. And the rules are, they're quite right, that the £50,000 doesn't apply to close investment holding companies, but there is an exception. And the exception is where the company holds land, and the land is let commercially to unconnected persons. So in other words, if it's a genuine buy-to-let, and you're letting it out to somebody who is not a member of your family, then even if you're doing this through a company, those you still pay 19% on the first £50,000 of profits. But if you hear anybody tell you differently, you need to question their knowledge on that particular subject. It's quite clearly written down in statute. What's the best way to go? If you've got existing properties and you're thinking, could I get them into a limited company because it might be cheaper for me? Possibly, but you need some decent advice, and you need to look at the planning on that, because when you put a company that you own already in your own name into a limited company environment, that is a transaction or deemed to be a sale for capital gains tax purposes at the market value of the property at the date of transfer. So if you've got a property that's appreciated quite a lot in value since you first bought it, and you're thinking you might want to put it into a limited company, get some advice, because you may be landing yourself with quite a large capital gains tax bill on putting that property into the company that you're maybe not aware would be the case. And potentially as well, stamp duty, land tax payable at 3% surcharge by the limited company on the transfer of that property. So the answer with that is be wary, take your time, assess the implications, as well as the short-term implications, as well as the long-term benefits. And that's basically what it's all about. It's about not just looking at today and the position today and what's best for me now, but it's also looking much further forward. What are your aspirations with the property? Is it to give you an income in retirement? Is it to build a larger portfolio? Is it to build this supplement income now? All those the answers to those questions will determine whether corporate or personal ownership is best. And again, if the corporate route is best and you've got more than one property, do you put them all under one company ownership, or do you look to have more than one limited company, each acting as a special purpose vehicle for that individual property? The only reason really of doing that would be to ring fence properties against risk from other assets that are owned by the company. So if you've got one property that perhaps has some structural defaults, becomes significantly less valued than you thought it was, you're not risking the equity in any other properties in terms of that kind of situation. So ring fencing each one into a different environment. I think the final point really to bring into this, we're covering most of the taxes in a very short period of time, so forgive me if it's sort of just glancing over the topic. Inheritance tax as well on properties long term could be an issue. So again, it's a case of looking at your long term sort of strategy with the properties. Is it to pass it on to a next generation? Is it to sell it to supplement retirement income? If it's to pass it on to the next generation, then there may be another merit in looking at the company route and having different classes of shares within the limited company that you could give to the next generation now, but it doesn't mean to say that they're entitled to any income from that property for the time being. That's entirely at your discretion. But it does mean that you've already passed some of the value or the future appreciation in value in those properties outside of your estate calculation for inheritance tax purposes. So, as you're probably realizing just from this very short overview of sort of taxation of property, it is an incredibly complex area. We're balancing income tax, potentially corporation tax, stamp duty, capital gains tax, and inheritance tax, all within one planning project. And that can make it quite a difficult thing to give, as I'm sure you'll appreciate, a rule of thumb to say, yes, buy in a company, no, buy personally. what I would recommend to anybody who's thinking of going down this route and doesn't quite know the answer as to how they want to buy it, just take a bit of time and assess what you actually are looking to gain from your property investment. Is it capital growth? Is it short-term income? Is it income in retirement? Is it to build up wealth to pass on to the next generation? Think about all those questions and have the answers to all those questions, and then perhaps get a bit of advice or research further and try and come up with the right solution for your individual needs. Not the ideal conclusion to give on something like this, because it'd be lovely to be able to give you an answer and say, yes, you need to be doing this or you need to be doing that. Other advantages of company route, obviously limited liability protection, although that can sometimes with the first property be subject to personal guarantees anyway. The obvious tax advantages we talked about. Disadvantages, well, one of them is you pay people like me more to deal with accountancy for a limited company than you do as an individual buy-to-let investor. Generally, fees are probably twice as much for limited companies than they are for individuals. So you have to make sure that the advantages are outweighing any additional costs. There's a cost of setting up the company. But beyond that, companies aren't complicated as long as you get them set up properly and they meet your requirements. I think Paul said I've got about 15 minutes, so I think I've probably waffled for 15 minutes and bored you all sufficiently in that time. But obviously any questions, save them up for when Paul's finished and we'll try and answer them.
Thank you, Geoff. And I think that's the key. Once, if you're a landlord already and you're looking for further purchases or you're looking to enter the market, I think it's making sure it's right for you, working out what your strategy is as well. I'll come on to that in a minute, and then making sure you speak to a specialist accountant such as Geoff, just to make sure you get the structure right to start with. It will save you lots of time and money in the future and headaches as well, potentially. We do send all of our landlords to Geoff if they haven't seen them already, just for that very purpose. But yeah, so there's in terms of, I mentioned I'll give a market overview as well. So we're actually seeing a sort of an influx of new landlords for the first time in a few years. So again, without going into too much depth on the tax situation, but tax has changed quite dramatically in 2016. And since then, we sort of real drop off on new landlords. But we're starting to see a pickup actually recently. And I think one of the things that's attracted is yields at the moment, obviously inflationary environment where, you're still not earning a pittance in interest or savings accounts with the banks. Obviously, you've got volatility of share markets, especially given Russia-Ukraine war, etc. So property can be seen as a slightly more stable and predictable income. Of course, it makes it a lot more difficult to sell in an emergency because, that takes months, as it were. But we are starting to see a lot more landlords. I think there's also a lot of people coming up to retirement, accessing pension pots and using some of their sort of tax-free lump sums to sort of make purchases into that area. And I think that's part of the reason we're seeing a real influx and a noticeable growth in first-time landlords. But yeah, I mentioned a few times in terms of strategy, and I think that's also a key part of the equation. Had landlords, some landlords like to buy property and want to make an income or growth on it, but I think it's really important to either work out for yourself or talk with a professional about, what your end goal is and what your strategy is. So again, is it to defer income to retirement, or is it for, capital uplifts, or is it just to protect your capital? Or is it just to, start creating an income to replace work at some point? And that can sort of really determine what sort of properties you go for. So traditionally, you'd see higher yields with maybe cheaper properties, such as apartments, but you might get higher turnover of tenants in that, so that can cost, which can sometimes mean, increased maintenance costs. All the way to sort of lower yields with higher value properties, but then you might tend to attract, say, a family that might not move for years and years and years. So again, sort of quite low maintenance from that point of view, but you might have a lower yield. You also get sort of with new builds as well. Somebody wants just something that they just don't have to worry about. They're quite busy people and they just want to buy, again, a new build apartment, for example, and tuck it away in a limited company, or, sort of to build income for the future there as well, because they just don't have the time or inclination to, maintain the property. Good thing about new builds is that, you tend to sort of not have to worry about doing too much to them for 5 to 10 years. So that's, I think it's always key to talk to somebody with a sort of a real wide experience in that area in terms of the right strategy for you. And whether that's an accountant such as Geoff, or, myself, I'm a mortgage advisor with a background as a landlord and owns a lettings agency. So I think it's just making sure that you find that professional that's a bit more well-rounded and holistic than maybe some, some sort of potential brokers or consultants out there. So that'd be key for me. I mentioned the sort of discuss, and this might cut into some of the questions, but yields at the moment, again, are quite good on apartments. So we've seen a yield after sort of leasehold service charges of around 5.7% on some apartments recently. So, that's a really good starting point for when somebody might be getting 0.1% interest in the bank. They're getting potentially up to 57 times that on a rental property. So that's why we're seeing a sort of a growth in first-time landlords, and again, even portfolio landlords coming back to the market and making further purchases. And interesting market trends as well. We're seeing apartments are starting to grow in value, but what we noticed last year, which made them really, really attractive to landlords, is that they were kind of at roughly similar values as to what they were sort of over the past 4 years. They've hardly moved, whereas houses have sort of gone up, almost exponentially, sort of ridiculous price increases on freehold houses, whereas we've noticed sort of apartments were struggling. And there's a few reasons for that. Again, a lot of people wanted outside space, increase in building of apartments, but then also traditionally the largest stock of buyers for apartment were first-time buyers who are most negatively affected by COVID job insecurity. But since during that time of COVID, they might have been on furlough, spending less and saving, but they had that job insecurity, so they weren't looking to make purchases. Now they're coming back into the purchase market for apartments because they've got job security, and potentially sort of higher levels of savings than they've ever had before, thanks to not being able to spend it for a couple of years. So we're really sort of starting to see an increase in first-time buyers returning to the market, as well as landlords. So we're noticing actually apartments starting to now increase in value. I think they're still at good entry level points, and I think we will start to, continue to see that growth as there's more strength in the market there. I think, in terms of a really important point to note, though, of course, tax savings on limited companies, or potential tax savings. Bear in mind that mortgage costs can be a little bit higher, but that's why it needs a conversation with a specialist mortgage broker and an accountant as well, but to see if the situation is right for you. So it's just something to be aware of. The cost can be a little bit higher there. But, interest rates, as low as 2.19% on limited company buy-to-let mortgages at the moment. That's quite a unique deal at the moment, but, the rates can be quite competitive. But I think that's kind of a rough overview of why we're seeing sort of more, growth in the market again, and, tax savings and areas there. So I'd like to throw open the forum to questions as well. So, and myself and Geoff will do our best to answer. We have to be very careful to make sure we're not bordering on any actual personal financial advice. So forgive us if we have to be a little bit generic in times, but more than happy to throw open the floor to questions. I'm looking on Facebook Live as well, because I think there's a means and ways to put questions on that, but that's not my forte. So I'm just having a little look at that while we speak as well. And of course, I'm stuck on Facebook there. So let's come out of that and back on. So here we go. So first question, is it best to buy a freehold or a leasehold property? Again, I don't think there's any sort of special tax planning considerations for that, Geoff. But the only thing I'd say from a strategy point of view is I mentioned earlier, sort of leasehold properties have struggled a little bit. So until recently, so we're noticing where the rental prices were going up, but the prices were staying fairly stagnant. So it depends. If your strategy is to create income streams, then yeah, leasehold absolutely can be great. But if you want to sort of just protect the capital value of your money, then freehold can be a good strategy as well. And I think it's just having that conversation with an experienced professional about what your strategy is, and in terms of whether that's a mortgage advisor or financial advisor, and just working out your strategy and then sort of going for it. So we've got some landlords that just go for sort of 3-bedroom semi-detached properties only because they feel that that's a comfortable store of value and the yields are reasonable. And then we've got some that only go for apartments because they, like I say, they get the higher return. And what they've done, they're putting them into their limited company special purchase vehicles with the aim to sort of, keep buying properties within them until the point of retirement, and then they can take out some income as a sort of a reasonably sort of either to retire early or to support their retirement. So again, it goes back to there's not a one size fits all on that. I'm just waiting to see if there's any other questions come through. Oh, one's just come. I've just lost it. Lost the question. Apologies. Let's look at the chat. Here we are. If you're buying your first property, can you have it as a personal name and transfer limited, or is it better to start as a limited company? I'll let Geoff answer this because I think he touched on this about if you're not sure, and I think this is the key to getting a specialist property tax advisor, because again, not all mortgage advisors, all accountants, they're not all the same. Some specialise in different areas to others, whereas Geoff's a property tax specialist, and I know personally I've looked at this where you set up as a limited liability partnership. So if you're not sure, you can do that now and then move it into limited company in the future. So I'll let Geoff sort of go over that again about the tax advantages and stamp duty sort of considerations on that question.
Okay, thanks, Paul. Right, there's two considerations here. So one is the timescale you're considering between buying it personally now and transferring it to a limited company. So you've got to be careful that if you leave too long a period of time and the market's good and the value of the property's gone up, as I said before, when you do come to transfer that property into the limited company, there's firstly potential capital gains tax implications if the appreciation in value has gone over the personal capital gains exemption, annual exemption, which is currently £12,300. But secondly, the transfer could give rise to a stamp duty land tax charge because it would be deemed to be effectively a market value transfer, even though funds aren't passing hands, or at least the value of the outstanding mortgage on there would be deemed to be chargeable to SDLT. One way around that is if the property is being bought in joint names, perhaps with a spouse or partner initially, then either register a formal partnership with HMRC for that rental activity, or perhaps think about the LLP route for the initial purchase. The reason being that when you then transfer it to a limited company, you haven't got around the capital gains potential issues, but the transfer of an asset out of a partnership, and that would include LLPs, don't give rise to stamp duty land tax, irrespective of the outstanding finance or anything else. So yes, it can be done, but you need to make sure you have a strategy at the outset and a time scale, and whether it's better to buy now personally or buy in a limited company straight away, again, goes back to what I said earlier. It depends on your individual circumstances, whether you need the money from the buy-to-let to supplement income, and basically what your other income is at the moment.
So the question from Alan: is now a good time to buy a rental property? Again, everybody's different. It really depends on your own personal situation and circumstances. But, personally, I think, we are in inflationary times, and historically, property tends to sort of keep pace on its own with inflation. So it can be a good store of value. We are seeing strength in rental prices as well. I know there's a few concerns about rising interest rates. In fact, we're seeing lenders increase their interest rates faster than the Bank of England are increasing their interest rates. But they're still historically low. They're still, probably, I think that I've gone for a remortgage yesterday actually, and the client's rate was the same as it was 5 years ago. So everyone's in this sort of little panic about rising interest rates, but actually we're only back to where we were 5 years ago. So obviously rates dropped, but lenders got more competitive. So now, although it's similar base rates, lenders have been more competitive, but they're loosening off a little on that competitiveness. And I think because they were anticipating further rate changes. But we see in the press sort of about cost of living crisis, etc., and that could well impact on people's finances. But I think if you also look at the extraordinary couple of years that we've had, I think where people change their spending habits, and if you look at from a behavioural point of view, yes, gas and petrol and oil are going up, and electricity. So hopefully that changes. I know there's some very unusual external environment with the Russia and Ukraine war that's impacting on that. But you look at sort of what people are doing in certain lockdowns, they're buying hot tubs and lazy spas, and I think we all sort of turned to Amazon and bought just maybe junk that we didn't need. And I think that's the thing, we might, or almost twice weekly sort of takeaways or whatever. So I think that's possibly where we'll see expenditure cut first before we start, it starts impacting on, people's desire to buy property. I mean, we're noticing certainly it's still, an extremely strong market every time we take on a property at the moment. So, in a nutshell, is now a good time to buy a rental. It really depends on you, and that absolutely have a conversation with the financial advisor. But rental yields are still strong, and I think the property market is quite strong as well. So that it could potentially be. Next question. Is a limited company mortgage more than a buy-to-let mortgage, or how do they differ? So yes, in short, there's a little bit more risk for the lender. It's a bit easier to walk away from a limited company, although having said that, they will usually make you sign a personal guarantee, as Geoff alluded to earlier. So you'll usually find a little bit more risk for the lender, so there's a little bit more of a charge. But as I say, and you'll find sometimes the product fees can be a little bit higher. But however, what rates are, as I say, I had a quick sort of look on rates earlier, and they're as low as 2.19% on a limited company. I mean, that might not be a right product for most people, but it's when rates are as low as that can be quite attractive on a limited company. But you tend to find it's a little bit cheaper if it's in your personal name. Not life-changing amounts, but can be a little bit cheaper. I don't think there's one key difference though with limited company mortgages and personal buy-to-let mortgages is limited company mortgages might be more likely to lend you a higher loan to value than a personal buy-to-let mortgage, because some of them a lender will look at the rental yield and look at the ability to cover the interest costs and presumed interest rate, and some lenders are going as low as looking at the rent having to cover 125% of a presumed interest rate of 4.5%. So that means that's much more likely to get to you sort of a slightly more generous lend compared to in a personal name. It can be as strict as like 145% to, I've seen even 170% if you're additional rate taxpayer, of presumed interest rates of 5 or 5.5%. So what that in a nutshell means that if you buy in a limited company, you could potentially need a lower level of deposit. Usually, I mean, some lenders will do on a 20% or sometimes even less deposit, but the rates are quite hideous. So I'd always aim to have a 25% deposit for purchase, plus stamp duty, plus additional stamp duty, the additional stamp duty surcharge, plus your solicitor fees. And it'd be what I'd budget for that. Let's see if there's any questions coming via Facebook. I can't see any there. And see if there's any more company questions coming on. So I think that looks like that could be, if there's any burning questions, speak now or forever hold your peace. We have been recording this, so we will sort of, kind of send this out to anyone if there's any useful points that they wanted to sort of watch again or sort of repost onto Facebook. But it looks like we've come to an exhausted end of questions. So I'd like to, first of all, thank you all for joining. Thank you, Geoff, very much for your words of wisdom there. I think it's key just to see somebody like Geoff, who's a property tax specialist, if you are looking to increase or start a portfolio. But no, really thank you for your time and your expertise, Geoff.
Pleasure.
Okay, and as nothing else has come through, I'm going to bid you all adieu and thank you so much for attending. And we look forward to seeing you on future ones. Thank you.
Thank you very much. Bye-bye.
Bye.